Has recording started, Sanjeev?
Yes, sir. Please start.
Okay, thank you. So, a very good morning to all the students of foundation course of this great institute, the Institute of Cost Accountants of India, and hope you'll be giving your examinations for December 2023 term. So today we are going to start that online coaching classes from the headquarters of the institute for foundation course. And then after regularly the classes will be on for each level, foundation, intermediate and final. So today we are blessed to have with us our honorable council member CMA Manoj Kumar Anandji, with us the chairman TNDF committee CMA Vinay Ranjan ji, and with our senior director of studies and HOD CMA Arup Shankar Bagchi, and we have got the blessings of our president and vice president. So I'll request first to start with the welcome note from the chairman of Training and Educational Facilities Committee, under the aegis of which this online classes for the students are being started. Vinay Ranjanji, if you can have introduction.
Good morning, dear students, council members, and staff, faculty members, and other directorate staff. Good morning to all of you. I am really happy on the inauguration of Foundation online classes for the December term of examination. And I must congratulate all the students who have taken admission for the foundation course of the CMA. And CMA course gives a better opportunities in terms of accounting, finance, or in the commerce stream. And I request each one of you to take part in active learning and doubt clearing sessions and make use of the facilities that are being provided by the institute. And on this occasion, I also would like to make note that today is a Ganesh Chaturthi day. We started the classes on an auspicious day. When classes should go on very well, and I hope all the very best. I hope please make use of this session, and all the best for your December term of examinations also. And I also would like to tell you that the last date for making payment of exam fee for December is October 10th. Please pay the exam fee. Okay, timely. Thank you. Thank you, sir.
Thank you, Vinay Ranjanji, for your inspiring welcome note to all the students aspiring for clearing the foundation exam.
Thanks to
and also thanks to the faculty already joined, CMA Pranab Kumar Shikdarji, who has joined in this forum. So after this inaugural session is over, immediately we'll start the classes. So now we request a very senior council member here, CMA Manoj Kumar Anandji, who is the chairman of PD committee. Sir, if you can please give your address for the students. Sir, please.
Thank you very much, Dr. Nandi. Our chairman of this committee, Shri Vinay Ranjan ji, my very dear colleagues, Dr. Nandi, Bagchi Sahab, Sikdar Sahab has also joined. Most welcome, Sikdar Sahab. And dear students, you see, this is a very, very great moment for all of us to have inaugurated these online classes. This was a long demand from the students that we should have online things. And I must congratulate our Vinay Ranjan ji and Nandi ji, with whose efforts this has been made possible. About Vinay Ranjan ji, I will definitely like to speak at least few words for students' benefit. Students, we cannot have a better person than Vinay Ranjan ji, who goes deeply into each subject who will look into the study materials, who will look into your problems, and then who will try to get them sorted at the institute level. You see, you must be noticing change in our institute's working. We have a very active help desk now. If you apply to us, we will be immediately responding you back. And as very correctly mentioned by Vinay Ranjanji, this is a course which will really equip you to fight in the society and then to contribute also in the society by earning a very handsome amount. I wish you all a very successful career ahead, and I definitely look forward that most of you really work hard, slog, and understand the subjects very thoroughly. We are also in the process of running certain programs which will engage you very effectively into your subject related matters over a period of time. You are most welcome to write or correspond or WhatsApp with any of us, and we will be really very glad to take care of your issues and take care of your problems. We are also in the constant process of updating our syllabus, and we are also in the process of updating our relative issues, which will really equip you very strongly. I once again congratulate my colleagues Nandi ji, Bakshi Sahab, Sikdar Sahab, and under the overall leadership of our Vinay Ranjan ji to start this long-awaited program. Once again, wishing you all the best and thank you very much.
Thank you so much, Anandji, for your inspiring talk for the students. And now they are gearing up for the next level, that is the examination. So to conclude this very small introductory session, I would now request our very senior director of the institute and the HOD of studies, CMA Arup Shankar Bakshi. He will give a vote of thanks for this inaugural session for this online coaching classes for foundation course. Bakshi sir, if you can please come up.
Thank you, sir. Before giving the vote of thanks, I'd just like to take a couple of minutes, because whenever I'm in the midst of students, I can't help but go back to my student days. I would like to congratulate the students for having taken up the course. Foundation, as the name says, it will build up your foundation for the course. When you go through your intermediate and final, you will find that it's an invaluable course. It's a contemporary course which will assure you of a successful career. So students, take this opportunity. I can see 237 participants. I would request each and every one of you to attend not only attend this online courses, but to tell your friends that this online classes are coming totally free of cost. So please tell your friends that they should attend to get benefited from it. Now coming to the vote of thanks, I would like to thank the chairman of the TF committee, Training and Education Facilities Committee, CMA Vinay Ranjan, for having pushed us into making these online courses available at the earliest possible date. I'd like to thank our constant source of encouragement, CMA MK Anand sir, who's joined us from Delhi. He keeps on pushing us to ensure that students and members gets the best of the facilities that the institute can offer as a professional institute. I would like to thank CMA Pranab Kumar Shilda sir for being here with the students from time to time as and when we request him to come. And of course, my colleague, the senior director and the secretary of the TF committee, Dr. Debaprashanna Nundi, who has he's the architect of these online classes. Thank you so much, sir, for having put in motion these classes at such a very short notice. So dear students, welcome. This is the starting point of a great journey that we are going to take together, and I can assure you that no effort will be spared by the institute to ensure that this degree of yours, which you're going to get, CMA, will not only make you a proud member of the institute, but will take you to greater heights in your personal careers, whether you go in for practice or whether you go in for a job. I would like to thank the IT team, the DOS team, and everybody who had helped us to make this possible. And in absentia, I'd like to thank our President, CMA Dalwadi sir, our Vice President, CMA Bibi Nayak, who again is a constant source of encouragement and giving us directions every day to ensure that the students get the best of exposure in this professional institute. Welcome, students. Thank you so much. I hand over to Dr. Nandi sir to take the program forward.
Thank you so much, Mr. Bakshi. I think Anandji, you'll have some address for the students.
Yeah, no, just one small point. Thanks, Bakshi sir. I just want to say that if you can share our number after the classes, so that if any student wants to give us directly any feedback, they are welcome. You can share my number and you can share Vinay's number also, so that if anybody wants to give us any feedback, we will be most welcoming that. Thank you very much.
Thank you so much, sir. So what Anand sir has said to sharing their number. So I'd request students, if you go to the website, you will see the numbers of the council members in the list of council members list. So you can take their numbers, and if you want to have any feedback for the program, you can give them through WhatsApp or through text message. Also, our numbers, Mr. Bakshi's numbers, my numbers are also there in the portal. You can send your feedback directly. Okay, so I think we should not wait for a long, because our faculty is here. And we are going to start with the first session. So make a brief profile of CMA Pranab Kumar Shikdar. He is a qualified professional, a fellow cost and management accountant of this institute, MBA Finance, PGDBM, MCOM, with 27 years of industry experience and about 30 years of rich, in-depth and extensive experience in teaching, training and development and administration in reputed professional educational institutions, and having strong track records of extraordinary performance. So I will not go further into details, because you understand what caliber of personalities he is having. So we'll try to bring these type of personalities, these type of faculties in this forum in foundation, intermediate and final, so that you will be not benefited by only by teaching, but their that philosophy towards their life and towards your higher level of education and your professional journey. So with this, I'd like to end my introduction for CMA Pranab Kumar Shikdar. So now it's all yours, sir. So you can start your session on the paper 2 we'll be doing on fundamentals of financial and cost accounting. And as the time is short, what I have a brief thing for you, that faculty member, they will cover up many things. They have to cover up many things. The most important things they will cover up. And the routine of the classes that will be today, it will be hosted in the website. From where you have entered into this online forum, there will get the class routine. And I request everyone to check it up every day, because sometimes some emergencies, some routines may be changed, schedule. So it is better to have a look on the schedule at least 2-3 times in the website. So I think Pranabji, you can start your session and enlighten our students with your address. Thank you, sir.
Good morning to all of you. Respected Anand sir, respected Chairman sir, respected Senior Director of Studies, Dr. Devaprasad Nandi, respected Senior Director, Mr. Arup Bakshi, and respected Madam Mudimita Sengupta, and all the online coaching team who are actually helping us to carry on this particular training and classes, so the online classes are concerned. Now, very good morning to all of you students, and I welcome you for this particular session of fundamentals of financial and cost accounting is concerned. Now, you see, what is our motto? Motto is, as because we have joined in a profession and this profession is really growing every day. And I would like to congratulate to you, all of you, for joining this particular course. And after passing this particular course, you'll be in a position to establish yourself uh, in a professional field. And as this profession is concerned, it is my mother profession, and this profession has given me a lot of things. So, one humble request to all of you, my dear students, be sincere, be particular, be regular with your studies so that you are in a position to pass the examination at the quickest possible time. Remember, age is the one of the most important issues so far getting the jobs are concerned. So nowadays, our institutes, with the initiative of Dr. Devabhushan Nandi and others, the institute is going to have some campus placement, and you see lucrative jobs qualified students they are getting. And so it is your turn so that you can learn the course. Okay, you can pass the examination, final examination, and you flying colors in the examination, and also you're in a position to get a good job. Now, coming to the subject. Now you see, it is paper 2 of the foundation examination, that is fundamentals of financial and cost accounting. So as you know, there are two parts. One is fundamental of financial accounting, another one is cost accounting. Now, since you are going to be a cost accountant in the near future, remember your mother subject will be costing and also the finance backed by accounting and other curriculums. So for the new course which is actually being developed, so for syllabus 2022 is concerned, it is unique. So it is going to challenge any of the professional institutes of the world I'm talking about. Only thing is that perception, only thing is that how you are going to study and how you are going to utilize yourself so that you can come with flying colors in the examination and also in a position to get good job. Now I'm coming to the presentation part, and remember we'll be discussing the conceptual part which are actually being required. So far, this curriculum of the paper 2 fundamentals of financial and cost accounting is concerned. Okay, let us start. So is the file, can you see the file? Hello?
No, sir.
Just a minute. Now can you see the file now? Hello?
Yes, sir.
Yes,
We
sir.
can see the file,
Okay.
but I mean, the size, the font size.
Sir.
Yeah. Yes, sir.
Is it okay? Now I'm starting with this fundamentals of financial and cost accounting. And today we are going to have fundamentals of financial accounting. That is accounting fundamentals. Remember, each and every subject having certain learning objectives. So once you understand what is the learning objectives and what you are going to learn, That makes a real sense. So what I'm saying, once you go through today's that I'm going to present with you, so for the accounting fundamentals are concerned, you are going to learn what is called definition of accounting. Then salient features and objectives of accounting. Then classification of accounting. Then rules of double entry system. Limitation of accounting and systems in accounting. Accounting concepts and conventions. Now, so for the introduction to accounting is concerned, our first concern is the first question that will come in our mind. What is the meaning of accounting? Now, accounting is an activity or process of recording business transactions. Now, at this juncture, we should first try to make a clear distinction between two things. One is called event and one is called transactions. Now, today in East Bengal, we are having Vishwakarma Puja. And also today there is a Ganesh Chaturthi. Now, if you think that you are going to celebrate, okay, that is an agenda you have made and you are going to celebrate, and nothing financial implication is there, you have not incurred any expenses, then it is an event. But when you will be starting your pujas and all other activities, then definitely there will be change in the financial position. Similarly, business, when they are actually, say, issuing a purchase order is actually being required for purchasing the materials. You are issuing a purchase order. Now, this issuing of purchase order, okay, is not going to have any financial impact unless and until you are going to pay the supplier who is going to supply you. So, events are nothing but it is some particular issues that is actually related with, but transactions actually means there is a financial position of the business. So business will be getting certain amount in terms of money and business will be paying in terms of money. So it is a language of business. So accounting is nothing but is a language of business through which we are in a position to justify that what business is doing and what are the various activities which are actually being performed in running with the business, so and so forth. Now, what is the purpose of accounting? The purpose of accounting is to present data, that is financial data, in a systematic way so that profit or loss of business can be ascertained during a particular period of time. Now, actually, what I am saying, our objective is to find out whether a particular business is going to earn certain income in the way of profit or whether the business is running at a loss. So for that particular purpose, definitely we are going to record the transactions in a systematic manner, and then we are going to prepare the final accounts in the form of preparation of trading, profit and loss and balance sheet. And from the trading, we generally get the GP, that is gross profit. From PL, we are going to get the net profit. And balance sheet is nothing but is a statement of it is a statement comprising of liabilities and assets. And on a particular date, we are going to know what are the position of the business with respect to different assets and with respect to different liabilities. So we'll come afterwards in a larger concept. Now, you see, accounting, there is a definition, as because there are so many authors, they have defined accounting in different manners. So the gist from the different authors, if we just narrate it, then accounting is a process of identifying, measuring, recording the business transactions. What is business transactions? I have said, say purchase of goods, sale of goods, incurring expenses, so and so forth, and communicating thereof the required information to interested users. Now, definitely there are certain interested users that business has to inform about the status of the business, what will be the financial position of the business, that we are going to see after few minutes. Now, you see, if someone is asked, what is the salient features of accounting? Okay, then accounting is an art. Why it is an art? Because you see, in order to perform recording of the transactions, so for the books of accounts of the business is concerned, it is to be recorded in a particular manner. That's why it is an art. Or lack of recording business transactions. Significant transactions are recorded, classified and summarized in a significant manner to ascertain profit. Remember, main objective of the business is to earn the profit. Otherwise, business cannot be, we cannot run the business. But apart from earning of the profit, there are certain social motives also, that is called social objectives of business. Now, transactions are recorded in terms of money. So, monetary unit is going to play a very important role so far the recording of the transactions are concerned. Now, what are transactions I have already said, and when I'm talking about business transactions, these business transactions are of financial character. That is, it should be expressed in terms of money or monetary terms. Then transactions should enable interpretation of results. Say, if you want to know what is the profitability of the business, what is the financial viability of the business, what is the earning capacity of the business, what is the activity of the business. So we are going to do it through interpretation of different results, through certain analysis that you are going to learn when you gradually come to intermediate and final level. That is called trend analysis, that is called ratio analysis, so on and so forth. Now, let us come to our next section. As we see, I have told you there are certain users who are actually going to have the accounting information, and that's why the heading is users of accounting information. Now, the accounting information is useful to various parties related to business organizations. Now, organization is going to be considered to be a business, is going to be considered to be a separate identity in the eye of law. Okay, so we will come to analyze the different convention, principles, generally accepted accounting principles. Then you will be in a position to understand what are these. We will be discussing. Now, the accounting information is useful to various parties related to business organization. The parties can be classified into two different categories. So, who are going to use the information of the business? Basically, there are two types of users. One is called internal users, and the second one is called external users. So, internal users we are having, they are management, owners, and employees. Okay. Then external users, they are investors, creditors, government, consumers, and competitors. So, business information is needed by both these internal and external users. Now, if you look into the chart that I have presented before you, so we are having internal users, management group, board of directors, partners, managers, officers, depending upon the nature of the business. And financial statements, say PL account, balance sheet, cash flow. There is a concept called cash flow, which means how cash is actually been coming and how cash is utilized. And starting with an opening balance, how we are in a position to arrive at the closing balance. That is called cash flow statement. Now, external users, financing groups is investors, lenders, suppliers, and public group, government agencies, labor union, employees, and customers. Now, when I'm talking about basis of accounting, then automatically the question of systems in accounting comes into the picture. Now, there are three main systems of recording business transactions. You know, there is a system called cash system. What is this? Here, cash receipts and cash payments are only recorded. That is called a system which is called cash system. Then credit or mercantile system, credit transactions are recorded under this system. And big system, it is a combination of both cash and credit system. Now, actually, so far the business organizations are concerned, companies are having predominating role. And in the context of company, definitely we are going to have the big system that is both cash as well as mercantile. Now, if I am going to highlight the process of accounting, then automatically you see there is a cyclical, that is, there is a circular relationship, that is communicating accounting information. Then there is a decision makers, internal and external users. Then economic events, actions, decision, then economic events. And accounting links decision makers with economic activities and with the result of their decisions. And it is a continuous process. That is called process of accounting. Now at this time, if you ask me, sir, why you should study accounting and how it is going to help us so for our future development, flourishment, and going to the top level, so for the various employments are concerned, my answer is objectives of accounting is nothing but is to maintain records of business. So there are various records we'll be discussing one by one. So the main objective is to maintain records of business, then to calculate profit or loss, make information available to various groups and users. Now, so for the functions of accounting, if you want to remember, we may remember through a buzzword or catchword or abbreviation that is called IMRCOS. Okay. So in this way, you are going to divide the various functions of accounting, and which is seems to be the one of the useful way for remembering what are the various functions of accounting. First, we are having the identification of monetary transactions and events. Now, I have already told you all events are not transactions. Okay. To be a transaction, there will be some financial change. So what the monetary unit is concerned. So identification of monetary transactions and events we are not going to record. But monetary transactions, definitely we are going to record. Then measurement of the identified transactions and events. Then recording of such transactions, classifying and summarizing the recorded transactions, obtaining the results of operations, and determination of financial state of affairs. That is whether company is in a position to earn return on the amount which is invested, or company has sustained losses. And automatically, on a particular date, what are the various position of assets and liabilities? Then analyzing and interpreting the results and position to help in decision making. So management has to take decision. So for the big businesses are concerned, that why the profit is so low, why it is not up to that particular level, etc. For that, they are going to make some decision that will be taken into the future to enhance the activities of the business in order to increase the market share of the business, so on and so forth. Then analyzing and interpreting, trend analysis, ratio analysis, I have already said. Then communicating such information to the users, both internal and external. Now, at this juncture, one important concept that will come in your mind, what is bookkeeping and what is accounting? Because until and unless you are going to keep the books, you are not in a position to account for the same, and you are not in a position to arrive at the financial statement of affairs of the company in the form of manufacturing, trading, profit and loss, and balance sheet as and when it is applicable. Now, bookkeeping is nothing but is recording phase of an accounting system. So, bookkeeping mainly based on recording aspect. But so far the accounting is concerned, it is the summarizing phase of an accounting system. So we are going to summarize different, say, transactions like, say, cash transactions, credit transactions, so on and so forth. Then it is the basis of accounting, and accounting is nothing but it is the basis for financial data. Persons responsible for bookkeeping are called bookkeepers. Persons responsible for accounting are called accountants. It does not require any special skill or knowledge. So what the bookkeeping is concerned. But nowadays, without any knowledge, no one can perform any job. So little bit knowledge is also required for keeping the books, or so far bookkeeping is concerned. So far accounting is concerned, it requires special skills and knowledge. Now, there is no question of any deployment of personal judgment of the bookkeeper, but so far accounting is concerned, personal judgment of the accounting is very much essential. For example, at the time of making provision for bad debts, personal judgment is necessary. What is provision for the bad debts? Say you have sold goods on credit, and remember about 95% of the transactions which I have witnessed while doing jobs in various organizations, including public sector, in a government organization, when transactions are actually being done on credit basis. Now you have sold the goods on credit, then automatically your debtors are arising in your books. Now all the debtors are not going to pay you in time. Okay, although there is a payment term that debtors are going to pay you, say within 2 months. But even after 2 years, say certain debtors are not going to pay you. So, taking into consideration the volume of debtors, amount of debtors, we are going to provide certain provisions in the form of provision for bad and doubtful debts, so that if the debtors are insolvent or not in a position to pay us, then there will be no direct blow on the face of the company. That's why the provisions are actually being created. Now, so far, bookkeeping is concerned, financial statements are not prepared from bookkeeping records. Please mind it. Financial statements, say PL, okay, balance sheet, we are not in a position to prepare directly from the bookkeeping or records. Financial statements are prepared from accounting records. So, definitely accounting records is used in a broader sense as compared to the bookkeeping records. Now, another point of distinction is it does not give the complete picture of the financial condition of the business unit. So only going through the bookkeeping record, that is records which are kept by the bookkeeper, you are not in a position to interpret about the performance of the company. But so for the accounting is concerned, it gives the complete picture of the financial condition of the business unit. Now, it does not help in complying with legal formalities. So for the bookkeeping is concerned. So there are certain legal obligations, compliance, so far business are required to be maintained. So for the Companies Act 2013 is concerned. Okay, there are certain records, accounting record, etc. the company has to maintain, and it is statutory and compliances. So for this particular business or organizations are concerned in the form of company form of organizations. So bookkeeping does not help in complying with legal formalities, but so for the accounting is concerned, legal formalities can be complied with the help of accounting. So it is a broader perspective. Now, in bookkeeping, it does not provide any information for taking managerial decisions. So if your departmental manager in a company, they are unable to make any decision only going through the records. So that's why we are going to rely on accounting. It provides information for taking managerial decisions. So managerial decision may be of different types. Okay, so you are going to learn when you come to inter and then final. Say whether we are in a position to discontinue a product, whether you are going to produce a new product, whether you are going to compete in a new market, okay, whether we are going to segment, that is segregate the markets in a different forms or not, that we can have. That is called decision making, nothing but. Now, bookkeeping, it has no branch, but so far accounting is concerned, remember, there are several branches like financial accounting, cost accounting, and management accounting. Financial accounting deals with financial transactions. Then cost accounting is nothing but is an ascertainment of cost, total cost and cost per unit, and also the selling price. And management accounting is nothing but it takes into account both the aspects of financial and cost accounting. Now, let us discuss some issues with reference to conceptual, legal, institutional, regulatory frameworks are concerned. Now, conceptual framework is what? A body of interrelated objectives and fundamentals. You see, let me tell you one thing. Because you are doing professional course, so your objective should be that you are going to be a professional in the future, a perfect professional, and you should go for right from your foundation level, the professional attitudes, okay, so that you are in a position to adapt so many things. Now, conceptual framework, what is this? The conceptual framework is a body of interrelated objectives and fundamentals. The objectives identify the goals and purposes of financial reporting. So, there is a corporate financial reporting that you are going to study in your final. I'm not going to discuss more on this financial reporting right now. And the fundamentals and the underlying concepts that help achieve those objectives. Now you see, each and every company having some visions. That is visionary ideas, that what the company want to be. Then there are certain visions that how we are going to fulfill this. That is visionary ideas that we are having. And you will find that each and every company, I'm talking about professionally managed company, each company having definite vision. Then they are having objectives, goals, and targets. So until and unless you are going to have the conceptual framework and it is related to your activities. So for the goals, etc., concerned for the financial reporting, okay, you are not in a position to rise to the situation. Then there is a legal framework because so far businesses are concerned. Then the legal framework, there are so many legal implications, statutory obligation, the business they have to encounter with, say Factories Act, okay, then say Foreign Exchange Management Act, okay, then Competition Act, okay. So there are so many acts that is nothing but this is going to create the legal framework. Then there are certain institutional framework, that is guideline issued by institutions for the development of the financial reporting, etc., and also for future guidelines, etc. Say, for example, Cost Accounting Standard Boards, CASB, the abbreviation of the Institute of Cost Accountants of India, has so far developed 24 cost accounting standards to facilitate cost accounting and reporting. So these are the framework within which you have to record and prepare your costs. Then SEBI in capital market operations, Security Exchange Board of India. Then the Reserve Bank of India in money market operations. Now, let us come to discuss about the various forms of organizations. Because each particular form of business having certain distinctive features, having certain specific objectives, having certain rules, regulations, and certain laws, bylaws under which the organizations will operate. So the first item that is coming in our mind is nothing but sole proprietorship. Now, a sole proprietorship is a business run solely by one individual proprietor. Okay. Usually, they are not supposed to operate under certain specific regulation or the legal requirements. But still, you see, if their turnover, that is sales exceeding certain limits, they are subject to some other legislation. That is, they are required to pay income tax under the Income Tax Act 1961. Then comes partnership. So definitely, in order to form the partnership, you are going to have that you have to register yourself. If you want to be a registered partnership business, then you are required to form the partnership with reference to Partnership Act 1930. So a partnership is defined as the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. So in your 11, 12 commerce studies, or those who are in first year, so the commerce courses are concerned, you have already gone through organization of business organizations, etc. And you are aware of these terms, that is sole proprietorship, partnership, etc. There is another formation of partnership that is called limited liability partnerships. So limited partnerships, in short, it is called LLPs, allow for a partnership structure where each partner's liabilities are limited to the amount they put into the business. That is, depending upon the amount of contribution they are going to make into the business. Then comes company, and definitely nowadays companies are 2013 and as amended, and a company is a legal entity formed by a group of individuals termed as shareholders to engage in and operate a business enterprise in a commercial or industrial capacity. Now, based upon the different aspects, sole proprietorship, partnership, LLP or company, they are actually going to maintain certain accounting records, and also there are certain components of financial statements in the form of different forms of businesses like sole proprietorship, partnership, LLP and company, sole proprietorship, manufacturing, trading, then profit and loss account, balance sheet. So if you are a manufacturing organization, then automatically you are going to prepare manufacturing account. Then trading, profit and loss account and balance sheet. In partnership, apart from manufacturing or trading, there will be preparation of profit and loss account, and partners, they are going to appropriate the profits between the partners. So they will be having preparation of profit and loss appropriation account, and obviously the balance sheet. In LLP, we are having profit and loss and balance sheet, and in companies, we are having statement of profit and loss, balance sheet, cash flow statement. I have already told what is called cash flow statement, and statement of changes in other equity. That is whether there is an increase in the equity or decrease in the equity, that is equity shares, it is actually to be calculated. Now, we are coming to very important concepts like accounting principles, concepts and conventions. Now, entire accounting perspective is dependent upon certain accounting concepts and conventions. Now, what is accounting concepts and conventions? You are required to understand. Now, there are certain generally accepted accounting principles. In short, it is called GAAP. And these GAAP are the basis for preparing accounting system to give results of business transactions. Okay. So, if you want to prepare the accounts and financial statements, etc., we have to give emphasis on the generally accepted accounting principle, that is GAAP. And these are called the base for preparing accounting statement to give results of business transactions. What is the result? I have already told you. Whether business is running at a profit or business has sustained a loss, what is the financial position of the business, so on and so forth. The accounting principles are based on three important aspects. They are relevance, objectivity, and feasibility. Now, what is relevant and what is irrelevant? The business has to decide, the accountant has to decide, okay, the manager has to decide what is called relevant and what is irrelevant. Objectivity, definitely objectivity is to run the business in the form of a going concern, to earn profit and to grow the business. And feasibility also tells us whether we are going to do the business and with different generally accepted accounting principles, whether it is actually to be followed or not, that feasibility we are going to justify. Firstly, the results of accounting statements are relevant to the people who need accounting information. I have already told you and shown you what are the users of accounting information. Secondly, accounting information are free from personal bias. So there is no question of any y is equal to function of x. That means value of y is dependent on x. That is called biasness. Or if a coin is tossed, then automatically there is a 50% probability that head will come and 50% probability that tail will come. And if you toss a coin, every time head falls and tail falls, that means the coin is biased. Then, hardly it is feasible to give information without undue complexity or cost. You see, cost is one of the most important elements that we have to take into consideration while framing our objectives, framing our policies, so on and so forth, that if the cost exceeds the budgeted cost or standard cost, then automatically there will be some problems. Now, thirdly, it is feasible to give information without any complexity or cost. Now, on the basis of these aspects, the accounting principles are classified as accounting concepts and conventions. And that we are going to discuss meanwhile. Now, what is called business entity concept? Because if you are the owner of the business, then ownership and business, it should be a different identity. That's why when a proprietor in a sole proprietorship business, when he is contributing certain amount of money in the form of capital, then we are going to record, say, cash or bank account debit to capital. So this capital is nothing but is an internal liability of the business. And cash or bank, when we are preparing balance sheet, then cash is a real, it is an asset, real account, and bank also it is a real account. But when we are going to pay the amount to anybody, then bank is said to be artificial personal account. That is giver of the amount on behalf of the business. Basically, in accounting parlance, we are going to have two such classification. That is a old classification. That is personal, impersonal. Accounts are classified into personal and impersonal. In personal, we are having natural person's account, like myself, yourself. Then artificial personal account, namely a company account, bank account of a particular entity. Okay. Insurance company account, so on and so forth. And apart from these two classifications, there is another classification which is known as representative personal account. And representative personal account generally takes into account, say, rent outstanding, salary outstanding. That is, it will represent to whom the salary is actually being due. And in impersonal, we are having, that is, real and nominal. And of course, in real, we are having tangible real and intangible real. Tangible real means those assets which can be touched, felt, and can also be measured in terms of money. Intangible real means the accounts which has no existence. There is no physical appearance of that particular asset. But it cannot be touched, it cannot be felt, but it can be measured in terms of money. That is goodwill, patent right, copyright, etc. And in case of impersonal, definitely we are having, that is, nominal accounts concerning all incomes and gains and concerning expenses and losses. Rather, it is better to say expenses and losses, incomes and gains. So that is the periphery. Now, business entity concept tells us we are going to consider as a business as a separate identity. And ownership and the business definitely should be separate. So business is an artificial person separated from its proprietor or owner. Only business transactions recorded in the books of account, but no personal private affairs of the proprietor or owner. But when there is a withdrawal of money by the proprietor from the business, that is called drawings. So your capital to that extent is reduced on the account of drawings. Okay. Therefore, the proprietor is treated as a creditor and the capital contributed by him is treated as a liability, which will appear on the liability side of the balance sheet. So balance sheet having two sides, liabilities and assets. And in liabilities, we are having both internal liabilities and external liabilities. That we are going to discuss more vividly when we come to the final accounts. Then the question of money measurement concept. So how you are in a position to measure your profit or loss? Definitely in terms of money. So all business transactions must be expressed in terms of money for being recorded in the books of accounts. Okay. It means that non-monetary transactions having no, that is called non-monetary transactions, cannot be recorded in the books of accounts. Just for an example, I have cited, say, value of employee and employer relationship. So it cannot be quantified. It cannot be measured in terms of money that we are going to record. No. Then marketing strategies. Value of human resources do not appear in accounting, but for your convenience, human resource accounting is also nowadays done. Human resource accounting, that is a different issue. This concept makes an assumption that value of money remains constant. So it fails to consider the effects of inflation or deflation. You see, today you have purchased goods worth rupees 5,000, maybe on cash or by credit. Same goods are going to cost you after 6 months, say 6,000 or 5,500. That is due to inflation. Okay, so we are going to give emphasis on inflation, not on deflation. Then comes going concern concept. Now the objectivity is how long the business will be continued. What will be the end? Okay, if you go to a seaside, you find that the end where you are standing, the other end you cannot see. Okay, I'm talking about an ocean or a sea. The side you are standing, other side of that ocean, you are not in a position to view or witness. So we do not know how far the organization or the business or the company or the partnership business, limited liability partnership business or sole proprietorship business will be continued. So it will continue until and unless it is actually being dissolved or wound up. So this concept makes an assumption that members may come and members may go. So these members I'm talking about with respect to company, that is shareholders. In other words, continuity of business activity is assumed. Okay, therefore, concept supports the treatment of prepaid expenses as assets. Say you have prepaid salary. Salary you have paid in advance. So that you are going to record in this particular year as an asset, so that it will be adjusted in the near future with the salary of the employees. And while preparing the final accounts, we are going to take into account the benefits that we have received, but apart from that, we are also recording certain benefits you have received but you have not paid. So in the near future, within a span of 1 year, you are going to pay that amount. That is called current liabilities. It is to be liquidated within 1 financial year. So the idea is outstanding liabilities, prepaid expenses, etc. We are going to record on the perception that business will be continued and it will be adjusted in the next year, so on and so forth. Then comes one of the most important aspects of recording your assets in your books of accounts, and finally the same should be recorded on the face of the balance sheet. So from that we are having the concept that is called cost concept. So when the assets are acquired, so it is a capital expenditure. So capital expenditure, revenue expenditure, capitalized expenditure, deferred revenue expenditure, we are going to discuss. Now, when the assets are acquired, it has to be recorded in cost. Okay, so that's why. So for the cost concept is concerned, according to this concept, asset is recorded in the books of account at the price at which it is acquired. That is acquisition cost. That is at cost. Now, this cost is the basis for all subsequent accounting treatment for the asset. The asset recorded at cost price is reduced by depreciation. So depreciation is nothing but due to wear and tear of the assets and due to the passage of time, expiration of the time, the effective production capacity of the assets generally reduces. So after the end of the life of that asset, you are required to replace those assets by purchasing the new assets. Then who is going to give us, who is going to provide us the money? That is a debatable question, isn't it? Who is going to provide us? Us means business, the money. So definitely you are going to raise funds from different sources, long term, medium term, short term. Okay. But in order to replace the asset, old asset by a new one, you have to provide an amount every year from your profit known as depreciation, and the same is to be deducted from the cost of the asset so that it should reflect the written down value. So the cost price value is called book value of the asset. This asset will disappear from balance sheet when the life of the asset is over and sold as scrap. Thus the balance sheet is prepared on the basis of cost concept. Then obviously we are having a concept that is called dual aspect concept. Now you see, if you want to clap, then automatically we have to clap with our hands, 2 hands. Then there will be a sound. Similarly, in accounting we are having, each transaction is having dual aspect. One is debit, another one is credit. Now, this is the basic principle of accounting. All business transactions involve a twofold aspect. One is receiving a benefit and giving out a benefit. So these are the two aspects. If an asset is purchased in the business has to give out cash or the obligation or pay for it. For example, if furniture is purchased for rupees 1,000, the business has to pay rupees 1,000 to the seller of furniture. Thus, a giver necessarily implies a receiver, and a receiver necessarily implies a giver. Okay? So, every business transaction affects two accounts. Therefore, we can say every debit has got corresponding credit and vice versa. Now, double entry bookkeeping is a system of accounting by which receiving and giving aspects of each transaction are recorded at a time. Now, we are going to clarify, or we are going to discuss. So far, this double aspect is concerned in the form of equations. You see, as per the double entry system, your total assets will be exactly equal to your total liabilities. Now, assets can be grouped under different heads. Fixed assets, okay, current assets, loans and advances given, then miscellaneous expenditure to be extended or written off. That is called fictitious assets, having no stake. So we'll discuss more when we come in to prepare the final accounts. So we are having assets is equal to liabilities, and value of total assets exactly is equal to value of capital, that is internal liability, plus liability to third parties. So we may equate capital, which are nothing but these are total assets minus liabilities to third parties. Now we are having the next most important concept, that is accounting period concept. Now remember, each and every company, as per the guidelines of the income tax, they have to start their year from the first day of April, and that is to be concluded the following 31st March. And from that, we are having the concept called previous year, financial year, accounting year, income tax point of view. But if you are going to maintain your account starting from January to December, so that months are available on the page of the calendar, that is called calendar year. But whatever may be the concept, accounting period concept means there will be 12 months starting from either from January to December or from April to following 31st March. That will be a period of 12 months. Because we are going to ascertain the profit made by the business or loss sustained by the business within this span of 12 months. If we are going to measure the profit or loss with indefinite period of time, that is not feasible. So you have to restrict yourself so far your 12 months period is concerned, so that you can justify whether the business is running at a profit or the business has sustained any loss. Then there is a concept called matching concept. So what you are going to match? So you are going to match the expenses against the revenues. So matching concept tells us it is necessary to compare or match the revenues earned with the expenditure incurred during the accounting period. So expenditure may be revenue, because after certain time today, I'm going to discuss about capital expenditure, revenue expenditure, deferred revenue expenditure, capitalized expenditure, revenue profit, revenue loss, capital profit, capital loss, etc. Now, expenditure over revenue is a loss, obviously so. Therefore, this comparison of revenue with expenditure is a very important concept of account. So you are unable to justify until and unless you are going to batch the expenses with your revenue. So you are not in a position to justify until and unless you are going to batch the expenses against revenue, the profit made or loss sustained by your business. The next pertaining concept is realization concept. So this makes a very, very good sense of accounting in the form of realization concept. This concept is also known as revenue recognition concept. So what is this? According to the concept, the revenue is considered as earned on the date when it is realized. So can I repeat? According to the concept, the revenue is considered as earned on the date when it is realized. And that is if the goods, services are sold to customers, the customer becomes legally liable to pay for. Obviously so. So this concept is very, very important for ascertaining extra profit earned by a business concerned during a particular accounting period. So what you are going to realize or what is realized, that is called revenue recognition concept. Now, apart from that, we are another concept because this is called objectivity concept. So all these concepts are important because question will be coming from this in your exam. Objectivity means a material thing that can be seen or touched. So there must be some evidence or proof regarding financial transactions in the form of invoices or vouchers. Now, invoice is nothing but if you place a order, that is called purchase order, on the seller as a buyer, then seller is going to raise a sheet or sheets of paper giving details of the purchase order, descriptions, quantities, amount in a particular form that is called invoice. So, in objectivity concept, objectivity means a material thing. Now, what is material? I will discuss just after a few minutes, please. Objectivity means a material thing that can be seen or touched. So, there must be some evidence or proof regarding financial transaction in the form of invoices or vouchers. So, there are certain vouchers. These are all proof for payments, vagara, vagara. Evidence should be such which will minimize the error. International basis, international basis of fraud. Accounting record should be based on the documentary evidence so that it is easy to verify and therefore universally acceptable. Say when you are purchasing something by cash, say small items, you are having cash vouchers with serial numbers 1, 2, 3, 4 like that. So objectivity is to judge that there is no intention to do some fraudulent activities, so that this should be recorded in a chronological sense. Now we are coming to another side that is called accounting conventions. Now what are conventions? The term convention means custom or customary practice or traditions. The accounting conventions are to be followed while preparing accounting statements. And these accounting conventions are as follows. That is, convention of full disclosure. So you have to report to, or you have to give full disclosure of your accounting statements so that it will disclose all significant information. Say you have constructed a building on a land, acquired fixed assets, including plant and machinery, that you have to disclose to the owners of the business. Say I'm talking about in a business company form of business to the shareholders. So according to this, the accounting statement should disclose all significant information or complete information about the business transactions. Interest of proprietors in a company, the shareholders, creditors, investors, if any. There must be adequate disclosure and publication of result of the business so as to dissipate any suggestion that hidden profits are accumulated to the detriment of consumers and those who work for industry. Now, you see, business having certain social responsibilities. Now, through full disclosures, you see, annual accounts, it is presented in the form of annual reports. And in the annual reports, 2 years figures are actually being given, highlighting all your financial information with respect to business in the form of manufacturing, trading, and indirect incomes and expenses, and also what are the assets and liabilities which are comprising of on the last day of the year. We are considering, say, 31st March. And it has to be disclosed fully so that in this way you are going to protect the interest of investors. In a business form, I will say interest of the shareholders. Because shareholders are said to be the true owners of the business, although there is a separation between management and ownership. Then comes convention of consistency. What is the meaning of consistency? Consistency means what accounting procedure you are going to adopt, that should be maintained on a consistent basis, year to years, until and unless there is a major change in the policy of the organization. Say I'm talking about, say, charging depreciation. Okay. Say this year you charge the depreciation on straight line method. Next year, diminishing balance method. Next year, annuity method. That cannot be done. That is a simple way of considering the concept of or consistency convention. Rules, practices, and procedures of accounting should be continuously observed and applied so that the management can take proper decision regarding problems or issues. So there are certain authors, renowned authors, they have actually opined consistency serves to eliminate personal bias and to even out personal judgment. But it must not become a fetish or has to ignore change conditions or need for improvements in techniques. So we are not going to discuss on this particular definition because it is somewhat cumbersome. Only thing I have mentioned, because these are the authors, they have mentioned about consistency. So what is consistency? In simple words, you must be consistent enough for recording the transactions, or without that you are going to apply for accounting practices. Then there is a concept called convention of conservatism. Now, what is this? Accountants are said to be very much conservative. They will take anticipated future losses, but they will not account for or take anticipated future profits. That is the convention of conservatism. But there is exception. Those who are from the accounting background, definitely you know there is a provision which is actually being created against creditors, Sunday creditors, that they are going to allow you certain discounts. I'm talking about cash discount. I'm not talking about trade discount. Trade discount is actually being allowed from the catalog or list price, and these are never recorded in the books of accounts. But cash discount is actually being made for from payment. Now, sometimes the suppliers from where you have purchased goods on credit, they are going to allow you certain credit period. That is, after certain time, you have to pay the money. You means your business. Now, accountants, they are not conservative in one sense. So, for the maintaining of provision for discount on creditors are concerned. Okay. Otherwise, accountants, they are very much conservative. They will consider all anticipated and future losses, but they will not consider anticipated future gains. Exception, provision for discount on creditors. Okay. So, from this parlance of convention of conservatism, we may justify that closing stock. You see, closing stock means the stock which is lying on the business on the closing date. It may be in the form of raw materials. It may be in the form of work in progress. It may be in the form of finished goods. What is work in progress? Work in progress is comprising of raw material, labor, and overheads. What is overhead? The cost which goes over the head of prime cost. That is a colloquial definition. What is prime cost? That is direct material, direct labor, and direct expenses. If you add these become prime cost. So that we are going to discuss in the costing. We will be doing the costing lessons. Now, from the point of view of conservatism, we are going to value the stock, that is closing stock, at the end of the year at cost or market price, whichever is less, because it is a principle of conservatism. When I am going to give emphasis on closing stock, that means finished stock which we are unable to sell, but on which we have incurred certain expenses, and that's why it is called unexpired cost. That will come in the credit side of your trading account and also in the asset side of your balance sheet. Okay. Then the convention of materiality. Say, instead of going hi-fi concepts, I'm just going to tell you, as a matter of fact, what is called convention of materiality. Consider you have purchased goods on credit for, say, 10 crores, your business. Rupees 500 worth purchases on credit you have not recorded. So 500 out of 10,000, out of 10 crores, no percentage is coming. So it is not going to affect materially. That means it is not going to affect you. But so for the compilation of gross profit, net profit, and the liability of the business is concerned, it is negligible. But if 1 crore is actually being not considered out of 10 crores, it becomes 10%. So it is having a material effect that your purchases will be down by 1 crore, so that your gross profit will be more, your net profit will be more, and there will be understatement of current liability in the form of sundry creditors to the extent of 1 crore. That is convention of materiality. Now, there are some authorities, they have defined this materiality. The American Accounting Association, AAA, defines the convention of material as follows. An item should be regarded as material if there is reason to believe that knowledge of it would influence the decision informed investor. So the example that I have given, that is going to dictate the convention of materiality. The term materiality means important, essential, relevant, etc. So according to this convention, only important and relevant information are to be considered. Unimportant and items can be left out or merged with other items. So that is the convention of material. Now, it is the time to remember certain points. Accounting definitely is an activity. It is defined as the art of recording, classifying, summarizing in a significant manner in terms of money transaction and events of the past, having the financial character and interpreting the result thereof. Then accounting concepts, business entity concept, money measurement concept, going concern concept, cost concepts, dual aspect concept, accounting period concept, matching concept, realization concept, objectivity concept. So these you have to remember well, because question will be coming from this. Still, we are having certain accounting conventions, and these conventions are full disclosure, convention of consistency, convention of conservation, and convention of materiality. And important accounting equations: assets is equal to liabilities, value of total is equal to value of capital minus liability to third parties, and capital is equal to assets minus liabilities to third parties. So before I go to capital and revenue transactions, just give me 2 minutes, so that after 2 minutes, I can take up this, that is capital and revenue transactions. And apart from this capital and revenue, there are something else that also we are going to discuss. So please allow me 2 minutes, so that we'll continue after 2 minutes of time. Thank you for listening to me. Have your patience. Try to understand what we are discussing. Only reading theoretically and bugging the subject, it is not going to help you. You have to clear your base. So over the last 30-35 years, what I have seen, you can mark, you can overcome the barriers initially. But when we will be coming to the upper level, of studies, if your concepts are not clear, then you will be known here. So passing the professional examination is not difficult, provided that you are disciplined, you are trustworthy, you are honest, you are sincere, and regular. So regularity and consistency are the two important aspects that you have to keep in your mind. And nowadays, what I would request you, your view should be helicopteric view. That is, watching from a helicopter about the condition of a particular place damaged by flood. So your objective should be helicopteric. And in this process, you should start reading newspapers like Economic Times, Business Standards, and always try to speak with your friends in English. Because soft skill that you have to learn, and that is most important. You may be first class first, but your appearance is not up to the mark. You are unable to overcome the interview. Then even getting 100 out of 100, that is not going to help us. So kindly allow 2 minutes. After 2 minutes, I will join and discuss these capital and revenue transactions. Hope you are in a position to understand me. And if you have any question, then you can also write it to me through this chat box, etc., so that I can clarify. So that will be done before 10 minutes of the closure of this class. So please allow me 2 minutes. Thank you for listening to me and having your patience. So welcome back. Now, first let me discuss. Now, first thing that is coming in our mind, what is a capital expenditure? Now, capital expenditures are the expenditures which are incurred for purchasing assets, mainly which are fixed in nature. Say you have purchased one land on which the office building will be constituted or constructed. So that is a one-time expenditures, and these are called capital expenditures for the acquisition of the assets. What is called revenue expenditures? Revenue expenditures are those expenditures which are recurring in nature and you have to incur every month. Okay. Now, apart from this capital and revenue, we are having a concept like deferred revenue expenditures. So deferred revenue expenditures are those expenditures which are incurred at a time requiring huge amount of money, say advertisement. And the benefit you are going to get out of this advertisement, as per the accounting point of view, or so far the views expressed by the department, it will be written off within a span of 5 years. Say 20 lakhs you have incurred, say for an example, 1/5 of 20 lakhs, that is to be charged to this current year's PL account, and remaining amount will be carried forward and will be shown in the balance sheet in the asset side as advertisement suspense. It has no stake. Only thing is that when you have incurred the expenditure in the financial period, say for the current year, you have passed the entry advertisement account debit to bank 20 lakhs. So there is a vacuum which is created on the asset side because over a span of maximum 5 years. So that's why 1/5 will be this year's expenditures and 4/5 will be carried over to the balance sheet to be written off for another period of 4 years. Now, there are certain expenditures which are incurred for the acquisition of the capital assets, which are known as capitalized expenditures, which are required to be added with the capital asset that you have acquired or purchased. Say, for example, transportation, freight, installation charges. So, if you purchase one plant and machinery, say for 10 lakhs, you have incurred you have paid freight to the extent of 2 lakhs. Then the journal entry will be plant and machinery account debit to 10 plus 2 plus 1, that is 13 lakhs. So you cannot debit separately freight account, installation charges account. So these are to be added with the cost of the plant and machinery you have purchased. And from that we are going to have or going to deduct the amount of depreciation on 13 lakhs. Not on 10 lakhs, but on 13 lakhs. That is called capitalized expenditure. So I have already discussed this. Now, capital profits and revenue profits, I am going to discuss. Capital profits means which are earned on which have no relationship with your purchase and sales activities. So capital profits may arise in a different form. You see, while ascertaining the trading profit of a business for a particular period, a proper distinction is to be made between capital and revenue profits. If a profit arises out of an ordinary nature, being the outcome of the ordinary functions, an object of the business, it is termed as revenue profit. That is profit arising out of purchase sales activities. But when a profit arises out of a casual and non-recurring transactions, it is termed as capital profit. The revenue profit arises out of the sale of. Generally, capital profits arise out of the sale of assets other than inventory at a price more than its book value, or in connection with the raising of capital, or at the time of purchasing an existing business. For example, if an asset whose book value is rupees 5,000 on the date of sale is sold for rupees 6,000, rupees 1,000 will be considered as capital profit. As simple as. Now, likewise, issue of shares at a premium in the form of company form of business. Company is going to issue shares, namely equity shares, preference shares, etc., etc. Okay. So, what I have written, for example, if an asset whose book value is rupees 5,000 on the date, rupees 1,000 will be considered as capital profit. Likewise, issue of shares at a premium is also a capital profit. The revenue profits stay distributed to the owners of the business or transferred to the GL reserve account. Now, you may be interested to know what is the meaning of GL reserve. GL reserve is actually being called as ordinary reserve, which is created out of profits and shown on the liability side of the balance sheet under reserves and surplus. And this reserve, GL reserve, is created for strengthening the business for the future. That is called GL reserve. So, revenue profits will be distributed to the owners. Profits are distributed to the shareholders in the form of dividends. Dividends are nothing but dividend profits. Dividend profit means part of the profits which are not retained by the business, what is actually being paid to the owners of the business in the form of dividend. Now, capital profits are generally capitalized, transferred to a capital reserve account which can only be utilized for setting of capital losses in future. So, you cannot use capital reserve part which is shown in your liability side for anything else other than setting of capital losses. If you are having capital loss, then you can set off this capital loss against capital reserve. Now, capital profits of a small amount arising out of selling of one asset. What is small, what is big, it is a matter of prudence. So, it is a matter of justification. The accountant has to justify, manager has to justify, because businesses are subjected to financial books of records, financial statements are subjected to audit. And there are certain statutory audits and also audit by Comptroller and Auditor General of India. So you cannot make any colorful thing and to show it as an expense of business, you cannot do that. So capital profits of a small amount arising out of selling of one asset, applying the concept of materiality. Now, whatever distinction I have made between capital and revenue expenditure, I have jotted this, I have already discussed. Now, there are certain revenue expenditure that should be treated as capital expenditure. Say, if you are going to witness, yes, these expenditures are revenue expenditures, but from the accounting point of view, these are to be treated as capital expenditures that we are going to discuss. The first item I have written, repairs. So repairs expenditure is revenue in nature. So I'm talking about minor repairs. I'm talking about regular repairs, nominal repairs. But huge amount incurred on a second-hand machinery in order to bring it to working condition, that should be treated as capital expenditure and should be added to the cost of machinery. As simple as. You cannot treat it as revenue expenditure. Similarly, wages Normally, wages are revenue in nature, but wages paid to the workers for the construction and installation of fixed assets will be treated as capital expenditure and added to the cost of that asset. Okay, so I think you are in a position to get what I am talking about. Then comes preliminary expenses. All the expenses paid in the process of formation of a company should be treated as capital expenditure. Right. Then brokerage, government stamp duty. So stamp duty is a levy, just you understand, by the government and by the state government. Brokerage, there is amount which is paid as commission to the brokers for issuing the shares. Government stamp duty and legal expenses, all the expenses paid on the purchase of a property will be regarded as capital expenditure. Then raw materials are stores. Mind this. These are generally revenue in nature. But if raw materials and stores are consumed in the construction or in the constructing a fixed assets or constructing a fixed assets, the same would be treated as development expenditure. All the expenditure incurred for the development of vines, plantation should be treated as capital expenditure. Okay. Deferred revenue expenditure I have already discussed. Then you will be interested to know the concepts which are called capital and revenue receipts. Mind that in your foundation, you should have a concrete base. Again and again, I am repeating. We will be solving some practical problems in our lessons. What is that? Foundation means pillar. If the pillar is not construct a multi-storied building, so you have to go stage by stage. That is foundation, interfinal. Okay, so that's why give more and more emphasis on concept building. And of course, don't try to mark. Okay, try to understand, try to explain yourself. Whatever you are learning, whatever you are reading. Okay, so that makes a real sense. Now, come to the concepts. I'm discussing about capital and revenue receipts. A receipt of money may be of a capital or revenue nature. A clear distinction, therefore, should be made between at this juncture. I would like to mention one thing. Say, if I'm talking about company form of business, in a company form of business, business is going to calculate taxable income from business. You will study it in your intermediate level under direct taxation. Okay? And remember, if you are having certain capital receipts, except capital gain means transferring of capital assets. Except capital gain, capital receipts on which you are not supposed to pay the tax. So that's why, whether in your income statement, you are going to, that makes a real sense. And for that, you have to have a clear understanding on capital and revenue receipts. A receipt of money may be of a capital or revenue nature. And a clear distinction between this capital and revenue are required so the receipts are concerned. Now, a receipt of money is considered as a capital receipt when a contribution is made by the proprietor towards the capital of the business or a contribution of capital to the business by someone outside the business. Capital receipts do not have any effect on the profits earned or losses incurred during the course of a year. Capital receipts can take one or more of the following forms. Additional capital introduced by the proprietor. The partnership business. By issuing fresh shares, say equity shares, in case of a company, or by selling assets previously not intended for resale. Okay, so these are all capital receipts. A receipt of money is considered as revenue receipt when it is received from customers for goods supplied or fees received for services rendered in the ordinary course of business, which is a result of the firm's activity in the current period. So receipts of money in the revenue nature increase the profits or decrease the losses of a business and must be set against the revenue expenses. Now, we are coming to solve one problem. The problem is classify the following items as capital or revenue. Okay. Now, the first item is an extension of railway tracks in the factory area. Now, let me explain, because I have worked in factory, I have the experience. You will find there might be certain railway lines connection outside of the business premise to a business premise or as a factory, where wagons, railway wagons will be coming in and they will unload certain goods into your factory. So an extension of railway tracks in the factory. So expenses incurred for the extension of railway tracks in the factory area should be treated as a capital expenditure because it is a one-time expenditure and also it will yield benefit for more than one accounting period. But remember, it is extension of your railway tracks, so it cannot be treated to be a deferred revenue expenditure. Okay, capital expenditure, of course, and benefit you are going to get out of that for years to come. But it cannot be treated as a deferred revenue expenditure. Mind that. Wages paid to machine operators. So what I call in costing parlance, direct wages. So direct wages or productive wages are the wages which are actually paid to the laborers who are engaged with the production. So wages paid to machine operators should be treated as a revenue expenditure as it will yield benefit for the current period only. Of course, so. Now, installation cost of a new production machine. So it is a capital expenditure, rather it should be capitalized. I have already told you. You cannot debit installation charges as a separate item. If you do that, your profit will be decreased unnecessarily. And there will be overvaluation of assets. So that's why installation cost of new production machine should be treated as a capital expenditure because it will benefit the business for more than one accounting period. But still, it is not a deferred revenue expenditure. Mind that. Next, Materials for extension to foreman's offices in the factory. Foreman are nothing but they are the supervisors. Now let me do one thing. Let me change my microphone because let me change my microphone and definitely. So am I audible to? Am I audible? Kindly tell me. Anyone? Anyone from the CMA office? Am I audible? Am I audible? Please. Okay. Now I'm talking about materials for extension of foreman's offices in the factory. One minute, please. So installation, materials for extension of foreman's offices in the factory should be. আচ্ছা আমাকে শোনা যাচ্ছে তো বাপ্পা?
Yes,
আচ্ছা
sir.
যদি না শোনা যায় না আমাকে তো বলবে তাহলে আমি ওই হ্যাঁ
Sir, you are audible.
not audible. You have to please tell me so that I can change my microphone. Okay. Now the concept is that is payment for materials for extension to foreman's office in the factory is a fact in the factory should be treated as capital expenditure because it will benefit the business for more than one accounting period. Of course. Now, rent paid for the factory, so that is a recurring expenditure. You have to, if you have taken the factory on a rental basis, you have to pay the rent to the owner. So it is a recurring expenditure being treated as a revenue expenditure, and you are going to get in a particular accounting year. Next, payment for computer time to operate a new stores control system. Mind this. So, mind the question, payment for computer time to operate a new stores control system. So, payment for computer time to operate a new stores control system. Mind that it should be treated as revenue expenditure because it has been incurred to carry out the normal business. So it cannot be treated to be neither a capital nor a deferred revenue, and also it cannot be classified under the head that is capitalized expenditure. Now we have own employees for building the foreman's office. So these wages is not a productive wages. It has nothing to do with the production is concerned. It cannot be treated to be the operating wages. It is a non-operating wages, and it is actually being paid for building the foreman's offices. Happens to be the capital expenditure because it will benefit the business for more than one accounting period. Now, virtually, we are now coming to the very concept which is called accounting cycle. You see, if I take a piece of paper and if I draw a circle, so where from we have started, the circle will go circularly and it will come to the point once more. So that is called accounting cycle, starting from journalizing of business transactions, posting it to the ledgers, balancing the ledger accounts, preparing the trial balance, preparing trading and profit and loss balance sheet. Now, accounting cycle can be studied with the help of the diagram that I have depicted. Say whatever I have said, you see the flow, you just see identification of transactions, business documents are prepared for or received, transactions are recorded in the books of original entry, that is called prime entry, we will discuss. Transactions are posted to the ledgers. If not last transactions for the period, and if last transactions of the period, then preparation of trial balance, passing of adjustment entries, preparation of final accounts, passing of closing entries. I will come. What is passing of reverse entry if it is required? That is the process. Now there are charts of accounts. Now the primary purpose of financial accounting is to record the transaction entered into by an organization during an accounting period. So that I have already discussed. To achieve these, various accounts are opened, and after the classification, it's classification exercise, the transaction gets posted to the ledger, which itself is classified as personal and impersonal. I have already made the discussion. Nature of accounts: personal, impersonal. Under personal, there are artificial personal account, representative personal account. And under impersonal, real and nominal. Nominal again, that is account relating to expenses and losses, account relating to incomes and gains. And in case of real, we are having tangible real and intangible real. We have discussed already. Now, you see, in a big organization, when the numerous transactions are actually being recorded, so for the complexity of the businesses are concerned, and due to huge flow of data, it has become quite a challenge to retrieve the information stored in the accounting records. So, it is for the purpose of effective management, accounting information, chart of accounts are there. Accounting equations, I have already told you. But again, I am going to look into this accounting equation perspective. We are having sources of funds equal to uses of funds. That is, where from the funds which are actually being generated, if we add, it becomes sources of funds. The funds that we are going to apply in different channels, it is known as uses of funds. Then proprietor's fund plus outside liability is equal to assets. Capital is equal to assets minus liabilities, total assets is equal to total equity. Here, total equity means shareholders' fund. Shareholders' fund means equity share capital plus reserves or surplus minus accumulated losses, that is debit balance of PL, minus miscellaneous expenditure to the extent not written up. Okay. So owner's equity is equal to total equity minus creditors. So key points are double entry. Then another key points, relationship that exists among assets, liabilities and the capital, and be expressed in the equation that I have already discussed. Liability, it may be long-term liability, it may be medium-term liability, or it may be short-term liability. So long-term liability means it is meant for more than 5 years. the funds you have raised for financing your fixed assets medium term means more than 1 year up to 5 years. And short term means within 1 financial year. Now, current liabilities are those liabilities which are required to be paid off within 1 financial year, say creditors. Okay. Now, let us do one problem, that is prepare an accounting equation from the following transaction in the books of Mr. A for the month of January. Invested capital in the firm 20,000. Purchase goods on credit from Das and Company for rupees 2,000 and 8,000. Purchase goods for cash 4,000. Sold goods for cash, cost is 4,000. Profit is 2,000. So the total sales price is 6,000. Next, paid to Das and Company in cash rupees 1,000. Then received from Mr. B. Banerjee 300. Paid salary rupees 6,000. Received interest rupees 5,000. Paid wages rupees 6,000. Now, what is our intention? Our intention to see how the transactions are going to affect assets, liabilities, and capital. So we are going to take one by one assets, liabilities, and capital. So that assets is equal to liabilities plus capital. The equation that I have already told you. Now, there will be 1, 2, 3, 4, 5 columns. First column will reflect the date. Second column will reflect the transaction. Third column assets. Fourth column liabilities, and fifth column capital. So liability plus capital is equal to assets. The invested capital in the form of money in the firm 20,000. So money purchase goods on credit from the Das and Company rupees 2,000. So it is 2,000, 2,000 plus. So revised equation is 22,000, 2,000, 20,000. What plan for cash plus 8,000 and money is going out 8,000. So that's why negative sign. Revised equation 22,000, that is 2,000 plus. So that 2,000 plus 20,000 is equal to 22,000. Similarly, purchase goods for cash 4,000. 4,000 is the plus. Liability is blank. So cash is going out minus 4,000. Revised equation 22,000. That is 2,000 plus 20,000. Then sold goods for cash. Cost rupees 4,000 plus profit 2,000. So 6,000 plus liability is nil, capital 2,000. Because profit will be added with the capital. Again, 4,000 minus revised equation 24,000, 2,000. That is 22,000 after deducting. Paid to Das and Company for 1,000. So minus 1000 minus 1000, revised equation 23,000. New energy for rupees 300, that is plus 300 minus 300. Revised equation 23,000, 1,000. Paid salary for rupees 6,000. So it is minus 6,000. Cash is going out. 17,000, 1,000, 16,000. Revised interest for rupees, received interest for rupees 5,000. That is 5,000 plus 5,000 plus. Then revised equation 22,000, 1,000 and 21,000. Paid wages 3,000 will be going out from your asset in the form of cash. Revised equation 19,000, 1,000 plus 18,000. So if we try to understand the accounting equation approach, the effect, that is, this method is built on the concept of accounting equation. The rules of debit and credit, that is, types of account, assets account to be debited increase, to be credited decrease. Liabilities account to be debited decrease, to be credited decrease. Capital account, debit means decrease, credited means increase. Revenue account to be debited means decrease, credited means increase. Expenses account, debit means increase, credit means decrease. Withdrawal account to be debited means increase, to be credited by decrease. So once the transactions are identified into double account and credit account, they are recorded in the books of original journal, and they are now the equation gives formation to double entry system of bookkeeping. This equation holds good for all business transactions and events at all period of time, since every transaction and event has two parts. Now, ultimately, we can come to a conclusion. Debit, the receivers credit the giver, that is in personal account. Debit what comes in, credit what goes out, that is real account. Debit all expenses and losses, credit all incomes and gains, that is nominal account. I've already discussed about personal account. In personal account, there are three sub-classifications. First one is natural person's account, that is my account, your account, Ram account. Canara Bank account, XYZ company limited account, it is artificial personal account. Vishal Revati account is a natural personal account. Then salary outstanding, wages outstanding will be representative personal account. Real account I have already said, I have explained. Nominal account I have already explained. Now, debit, actually, we are going to use, in case of debit as says here, in the case of credit. Now we are coming to journal. So journal is a book of original entry. This book is a record of day-to-day business transactions. The process of recording the business transactions is called journalizing. So an entry made in the journal is called journal entry. The journal having 5 columns, namely date, particulars, ledger folio number, in short we call LF number, debit and credit as it is shown. So that particular ledger folio debit have the concept of journal proper. What is that? In modern business, the journal proper is used to make entries for transactions which cannot be conveniently recorded in any of the subsidiary books. Okay, so subsidiary books, purchase the book, sales the book, return inward book, return outward book, bills receivable book, bills payable book, so on and so forth. Therefore, it is called residuary book, journal proper, and usually there are certain definite transactions which are passed through the journal proper. Number one, opening entries. So journal entries are made for assets, namely cash, furniture, stock, etc., brought in by the trader to the business. When the balances of assets and liabilities are brought forward from the books of the previous year, the current year's book, opening entries are also passed. For example, Mr. A commences business with cash rupees 5,000, furniture rupees 500, and stock rupees 5,000. So the entries will be cash account debit 5,000, furniture account debit 500, stock account debit 5,000, to Mr. A's capital account 10,500, being assets brought in towards capital. Now, when I am coming to closing entries, there is journal entries made to close the account at the end of the accounting period are called closing entries. Entries are passed to transfer stock account, purchase account, returns account, sales account to trading account, and the nominal account to the profit and loss account, and net profit to the capital. So we are having trading account debit to billing stock account, to purchases account, to carriage inwards account, to wages account, to returns inward account. So being opening stock, purchases, carriage inwards, wages, return inwards debited and transferred to trading account. So that is a part. Returns outward account debit, closing stock account debit to trading account. So being sales, return outwards, closing stock credited and transferred to trading account. And for gross profit, we are going to have the entry that is trading account debit to profit and loss account. Then in profit and loss account, we are going to debit and we are going to carry respectively salaries, rent, advertisement, postage and telegram, so and so forth. So being salaries, rent, advertisement and postage and telegram, debited and transferred to profit and loss account. So these are all revenue indirect expenses. In case of have indirect received account debit, discount received account debit to profit and loss account. Being interest received, discount received, credited and transferred to profit and loss account. Then profit and loss account debit to capital, that is in case of net profit. And capital account debit to profit and loss account in case of net loss. Now, we should stop for the day. And if you are having any question, okay, you have to tell me So these are all general queries actually. So these general questions, I have no answer actually, because I'm just taking 1-2 questions. Can we get the? Just a minute. Hello, there is a disconnection actually. Now I am back. So there are certain questions. So these questions is not related to our studies. Okay, so what I feel, if you are having any question related to today's class, so please feel free to ask me in the next class, and I will discuss if you have any specific question. Hello. Yes. So today I am just going to close and see you in the next class. Please keep in your mind whatever I have discussed. And if you have any question, please tell me in the next class, and I'll be glad to answer those questions. General things that I cannot answer, you have to refer to the institute, namely what is the final date of exam. Okay, so thank you very much for attending this online class. I think whatever I have discussed, you are in a position to understand that. And thank you. See you in the next class.
Thank
Goodbye.
you, sir.
Thank you.